Most people think investing is about picking the right asset. In reality, wealth is decided by what tier you put your money in. In this video, we're ranking the most common assets people invest in, from absolute money traps to true wealth machines. This is not financial advice. This is about patterns, probabilities, and long-term outcomes. To keep things real, we'll imagine putting $100,000 into each tier and watching what actually happens over time. Some assets shrink that money, some freeze it, and a very small number multiply it beyond recognition. Let's start at the bottom, where most people lose without realizing it. F-tier, financial illusions. F-tier assets are not misunderstood investments. They are financial illusions. They look exciting. They feel smart. But mathematically, they move money in the wrong direction. The clearest examples are lotteries and gambling. Every year, people spend over $100 billion on lottery tickets, not investing, just hoping. The average adult loses over $1,000 annually chasing jackpots designed to almost never pay out. Your odds of winning are so low that, statistically, thunderstorm lightning is more likely to find you first. Next in F tier, luxury purchases mistaken for assets. Expensive cars, watches, designer fashion, and gadgets bought on debt do not build wealth, but they quietly consume it. A new sports car can lose nearly half its value within a few years. These items signal wealth socially while weakening it financially. Then there are collectibles bought without deep expertise. From toy crazes to digital hype cycles, beginners are often sold the illusion of fast riches. Without expert knowledge and patience, most of these items become impossible to sell. Even valuable items can trap your money if no buyer shows up. The defining mistake of F-tier assets is confusing spending with investing. Real investments either generate cash flow or compound in value. F-tier assets do neither. Put $100,000 into F-tier and time works against you. In gambling, it disappears fast. In luxury goods, it fades slowly. In hype collectibles, it often gets stuck forever. This is not wealth creation. It's wealth erosion with better marketing. Now let's move one level up, where money survives, but struggles. D-tier, survives, but doesn't scale. D-tier assets are not outright traps, but they're far from reliable wealth builders. They can work under perfect conditions, but the problem is that perfect conditions rarely last. Most people who invest here don't lose everything. They just never get ahead. The defining feature of D-tier assets is fragility. Small mistakes, bad timing, or mild bad luck can flip these assets from profitable to painful. Gold and silver usually sit in D-tier. They're often marketed as safe havens, and historically, they do protect value during chaos. In major crises, gold has spiked sharply, sometimes over 20% in a single year. But when you zoom out, the long-term story becomes far less impressive. Over decades, gold barely outpaces inflation and consistently underperforms stocks. Commodities don't produce income. They just sit and wait. As protection, they make sense. As engines of wealth, they fall short. Another common D-tier asset is the single rental property. On paper, it sounds perfect. Tenants pay the mortgage, and you build equity. In reality, the numbers are far more fragile. Vacancies, repairs, taxes, and interest rates can quickly erase profits. Small landlords face the highest risk because there's no buffer. One bad tenant or one empty month can flip cash flow to negative. Without scale, real estate becomes unstable rather than powerful. What connects all D-tier assets is dependence on timing. They require things to go right, consistently. And when something goes wrong, recovery is slow. Put $100,000 into D-tier, and the money usually survives, but barely grows. Inflation quietly eats the real value while effort stays high. D-tier doesn't destroy wealth fast, but it wastes time. And time is the most expensive thing an investor can lose. Next up is the middle ground, assets that behave but don't accelerate. C-tier, stable but unexciting. C-tier assets are where money finally stops leaking, but it still doesn't sprint. These assets are not mistakes. They're just not accelerators. They preserve purchasing power and provide predictability, not breakthroughs. People choose C-tier when safety matters more than speed. Government bonds are the clearest example of C-tier investing. They're designed to protect capital, not to multiply it. Over long periods, bonds return just enough to stay ahead of inflation, sometimes. Compared to stocks, the opportunity cost is massive. Bonds behave like a financial parking lot, safe, quiet, and motionless. Real estate investment trusts also live in C-tier. They give exposure to property without ownership or management. Dividends make them feel productive, but interest rate changes hit REITs hard. When rates rise, REIT values often fall sharply. Over long periods, REITs usually lag broad stock markets while swinging more. They belong in portfolios, just not at the center. Some collectibles move up from F-tier into C-tier, but only with expertise. Art, rare watches, and classic cars have real markets. Wealthy investors often allocate small portions here for diversification. The problem is liquidity. Selling at the right price can take months or years. Without connections, these assets become trophies instead of tools. C-tier assets behave well, but they don't scale. They're best used as stabilizers, but not drivers. Put $100,000 into C-tier, and it will likely hold its value. But it rarely changes your financial trajectory. C-tier protects what you've already built. It doesn't create something new. Now we move to where real compounding begins. B-tier, consistent, compounding, reliable. B-tier assets are where the math finally starts working in your favor. These assets don't rely on luck, timing, or insider access. They reward patience, discipline, and time. Millions of ordinary people have built wealth here without doing anything extraordinary. Index funds form the backbone of B-tier investing. Instead of betting on individual winners, you own the entire market. Over long periods, broad market indexes have returned roughly 10% annually. Time turns small investments into large outcomes. Low fees, instant diversification, and high liquidity make index funds brutally efficient. The real power isn't speed, it's inevitability. Dividend-paying stocks also belong in B-tier. These companies share profits directly with owners. Long-standing dividend growers have historically delivered strong returns with lower volatility. The appeal is psychological as much as financial. However, higher dividends often mean slower growth. You trade explosive upside for reliability. Real estate moves into B-tier only when scale enters the picture. With multiple properties, risk spreads out. Vacancies and repairs stop being disasters and become statistics. Cash flow becomes predictable, not stressful. Appreciation and leverage work together over decades. The trade-off is effort. B-tier assets succeed because they are repeatable. Anyone who follows the system long enough gets results. Put $100,000 into B-tier and it doesn't sit still. Over decades, it can turn into 7 figures through compounding alone. B-tier won't make headlines, but it builds foundations. Now let's step into assets that demand more and give more. A-tier, powerful, but not for beginners. A-tier assets are where wealth starts to accelerate, but only if you can handle the friction. These assets don't fail because they're weak. They fail because most people can't access or manage them. A-tier rewards scale, patience, and experience. Private equity and venture capital dominate A-tier. These investments target companies before they reach public markets. Historically, top-performing funds have beaten public markets consistently. Returns often exceed 12% annually, even after fees. The downside is access. Large capital requirements and long lockup periods keep most people out. Liquidity is sacrificed for higher upside. Franchises sit firmly in A-tier. You're buying a proven system, not starting from zero. Marketing, supply chains, and customer demand are already in place. Well-run franchises can generate consistent 6-figure profits. The barrier is cost. Initial investments can reach 7 figures before doors even open. Approval isn't guaranteed, even with capital. Commercial real estate completes the A-tier. Unlike single rentals, income scales with size. Multifamily, office, and retail properties behave like businesses. Returns have historically hovered around high single digits with leverage. Entry requires significant equity and lender trust. Mistakes here are expensive, but so are the rewards. A-tier assets are not risky experiments. They are systems that scale once you can afford to enter. Put $100,000 here, and you're usually still below the entry line. It might secure partial access, but rarely control. A tier teaches a critical lesson. Capital unlocks opportunity. Now we reach the top, where wealth stops compounding and starts multiplying. S tier, where wealth multiplies, not compounds. S tier assets are not about returns. They're about control. This is where the richest people in the world actually play. Not because S tier is secret, but because it's misunderstood. S tier assets don't pay you for time, effort, or even capital. They pay you for ownership of systems. At the core of S tier are operating businesses. Not small self-employment businesses, but scalable, system-driven companies. These businesses generate cash flow whether the owner is present or not. The owner's job shifts from doing work to making decisions. Margins expand as scale increases. One system can serve thousands or millions of customers. Intellectual property is the quiet king of S tier. This includes software, patents, brands, media, and frameworks. IP is created once and sold infinitely. Marginal cost approaches zero. This is why software companies dominate global markets, and why brands outlive founders. Platforms are S tier assets with gravity. They don't chase users, users gather around them. Examples include marketplaces, media platforms, and financial networks. Each new participant increases the value of the system. This creates defensibility that money alone can't buy. At the very top sit holding companies. They don't operate. Instead, they own operators. Cash flow from one business funds acquisition of another. Risk is diversified while control increases. This is how dynastic wealth is built. S tier doesn't reward hustle. It rewards patience, leverage, and long-term thinking. There are no quick wins here. The payoff comes years later, but it's exponential. This is why the rich focus on ownership, not income. Most people argue about taxes on income. The wealthy structure ownership to legally minimize them. They don't escape the system. They own pieces of it. And that's the real difference between working for money and money working for you. If you liked the video, then comment below which tier you think is the most valuable.